Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know, first, Andreessen Horowitz's $15 billion fund weaponizes capital for AI and defense, pivoting from globalism to American dynamism. We'll analyze why this pivot is a turning point and how it could affect global tech competition and venture capital strategies. Second, Meta's 6.6 gigawatt bet on next-gen nuclear power from Gates and Altman-backed startups transforms the energy race for AI. So we'll discuss why this massive energy play matters and what it means for the future of AI infrastructure and national energy policy. Third, as collectible giant Funko falters, two AI startups ignite a platform war to disrupt the market with smart toys. In this episode, we'll break down their competing open versus closed strategies and what it signals for the future of interactive entertainment. Fourth, Stellantis scraps its top-selling plug-in hybrids, abandoning a 41% market lead in a major strategic pivot for its EV future. We'll examine how expiring subsidies and fire risk recalls force this U-turn and how it impacts the North American EV supply chain. Fifth, Silicon Valley insiders use exchange funds to quietly diversify their fortunes, revealing a hidden link between the AI boom and real estate. This discussion will reveal the psychology behind this de-risking trend and what it signals about insider confidence in the current tech rally. The most unexpected news in the venture capital world today has to be this. In a market that's been in a deep freeze, one firm just raised a staggering $15 billion. While overall venture fundraising has plummeted by nearly $100 billion from its peak, the Silicon Valley giant Andreessen Horowitz, also known as a 16Z, is amassing a war chest. This massive haul shows that while most of the industry is struggling, the biggest players are consolidating power at an incredible rate. However, if you zoom out, you'll see another layer of strategy at play. The venture capital world is splitting in two. Recent data shows that the top 30 VC firms secured 75% of all US venture capital raised in 2024. In fact, just 9 of those firms took in half of the total. This concentration of capital means that smaller emerging firms are being starved of cash, raising their lowest share in over a decade. It's a winner-take-all environment, and right now, the winners are the established giants. But the real story is where that money is going. This isn't just about finding the next social media app. A 16Z is creating dedicated funds with a clear mission. A massive $6.7 to $5 billion is for a growth fund. $1.7 billion is aimed squarely at AI infrastructure. And what really brought this to a head was the next development. When we hear AI infrastructure, most of us think of computer chips, but a 16Z is betting on the entire ecosystem, the picks and shovels of the AI gold rush. This is a different strategy from big tech companies, which are making huge singular investments in AI labs like OpenAI and Anthropic. A while back, we broke down OpenAI's $1 trillion capital as a moat Stargate push with SoftBank and Oracle and the frenemy dynamics around that mega build, so I won't rehash it. The latest development is that a 16Z is effectively funding the alternative, a diversified stack across tooling, data, and specialized hardware instead of one all-in lab bet. And as we discussed then, with early signs of diminishing returns to brute force scaling, this spreads risk if a single lab's compute arms race stalls. We also flagged how that mega build is increasingly financed by a new landlord class of debt and private equity, which amplifies the downside if demand lags. By contrast, this approach channels equity into many smaller, more adaptable providers that can win even if the bigger is always better thesis wobbles. And over $1 billion is being injected directly into what the firm calls national interests. We're talking defense technology, housing, and supply chains. This move also surfaces some tough ethical questions. Investing over $1 billion in defense tech brings a venture capital firm into a world with serious ethical considerations. After all, firms like a 16Z have to navigate a very fine line, especially with pressure from their own investors, like university endowments and pension funds, which often have strict ethical mandates. They have to define their red lines and prove they aren't funding autonomous weapons, but are instead focusing on what can be clearly defined as defensive technology. It's a high-stakes balancing act between innovation, national security, and ethical responsibility. So, what's the real endgame here? The firm's co-founder, Ben Horowitz, put it in the starkest terms possible. He said, "The technology landscape that we will be investing into is intensely competitive with China. At this moment of profound technological opportunity, it is fundamentally important for humanity that America wins." That quote reframes everything. This isn't just a stray comment. It's the core of a formal investment strategy, a 16Z calls American Dynamism. This doctrine represents a fundamental break from the traditional globalist approach of venture capital, which historically chased the highest financial return anywhere in the world. Now, they are explicitly fusing venture capital with nationalistic goals. A few days ago, we contrasted OpenAI's Go Big Stargate plan with Anthropic's Do More with Less posture. Today, the focus shifts from lab strategy to national capacity, defense, tech, housing, and supply chains as strategic infrastructure. We're seeing other major firms like Sequoia Capital and GGV Capital split their US and Chinese operations as geopolitical tensions make it impossible to operate in both. This isn't just business, it's a strategic move on the geopolitical chessboard. A 16Z, the legendary firm that backed giants like Facebook and Coinbase, is now explicitly funding the front lines of a global tech race. This latest round brings their total assets under management to over $90 billion. While the rest of the market faces a capital drought, Andreessen Horowitz is not just investing in startups, it is weaponizing capital to back one side in the defining technological competition of our time. Speaking of the immense resources needed for that competition, the battle for AI supremacy isn't just about capital anymore, it's about raw power. A tech giant just announced a deal that will make it one of the biggest buyers of nuclear power in American history, and the amount of energy thereafter is an absolute bombshell. Believe it or not, this is part of a bigger trend, a kind of tech baron nuclear renaissance. We're seeing private tech leaders, not governments, starting to shape the future of our critical energy infrastructure. A while back, we talked about how control over infrastructure is becoming the new choke point and how some players are choosing speed over sustainability to get there. Today, the focus shifts to a very different playbook: nuclear at colossal scale. Meta is teaming up with nuclear energy providers, including startups backed by tech titans Bill Gates and Sam Altman, to power its AI ambitions. This isn't just a simple energy contract. Meta is directly funding the construction of new nuclear reactors. This is where the situation takes a more complex turn. These aren't your grandfather's nuclear plants. Bill Gates' company, TerraPower, is developing what's called the Natrium reactor, a new design that uses liquid sodium for cooling, which aims to be safer and more efficient. Sam Altman's company, Oklo, is focused on even smaller micro-reactors. So Meta is betting on next-generation, largely unproven technologies to solve a very immediate problem. And continuing our last discussion about trade-offs, remember, xAI's Memphis data center opted for dozens of natural gas turbines to get fast, reliable power. Meta is choosing a different lane, long-lived baseload from advanced nuclear. And the motive here reveals the core conflict at the heart of the AI revolution. This isn't about powering your newsfeed. It's about the colossal energy appetite of artificial intelligence. It's because training and running these massive AI models requires a staggering amount of computational power, which in turn consumes vast quantities of electricity 24/7. Meta is building massive AI superclusters, like the upcoming project codenamed Prometheus, and they need a power source that never sleeps. The current energy grid simply can't keep up. A few days ago, we mentioned how some companies are deprioritizing sustainability goals to move fast. This move shows Meta trying to secure round-the-clock power without leaning on fossil turbines. The target number is jaw-dropping, 6.6 gigawatts of electricity by 2035. To put that in perspective, that is enough new energy to power the entire country of Ireland. So why nuclear? Why not a massive build-out of solar and wind? Interestingly enough, nuclear power is getting a major rebrand. The European Union recently classified it as a sustainable green investment. This move helps legitimize nuclear within the ESG world that's environmental, social, and governance investing, making it a convenient way for tech giants to meet their net zero goals on paper while securing the reliable round-the-clock power that renewables, even with storage, struggle to provide. We previously analysed how the power source you pick invites its own scrutiny. xAI's gas-heavy choice sparked local environmental concerns in Memphis. So Meta's nuclear path is as much about optics and policy alignment as it is about electron. This move positions Meta as a central player, not just in tech, but in the future of American energy infrastructure. In a statement, the company's chief global affairs officer declared that these agreements make Meta one of the most significant corporate purchases of nuclear energy in American history. But this raises a critical question about the hidden price tag. Historically, the long-term costs of nuclear power, like decommissioning a plant, which can cost over $1 billion, often fall to the public. While Meta is funding the construction, it's not yet clear who bears the liability for these massive future costs decades down the line. As we've discussed before, owning more of the stack brings leverage and responsibility. The bill may arrive long after the headlines fade. The company frames this as a national security issue, arguing that state-of-the-art data centers are essential to securing America's position as a global leader in AI. A while back, we noted the paradox of the Pentagon adding Grok to its AI agents platform, even as regulators probed XAI over problematic outputs, evidence that national security urgency can override ethical friction. Meta is tapping the same frame, but via energy infrastructure rather than software access. And they're not wrong to see it this way. When we place Meta's private sector-led answer alongside China's state-led approach, the global race becomes clear. This is creating a new form of energy nationalism. The battle for AI supremacy isn't just about code and algorithms anymore. It's now a high-stakes race for raw power, and the world's biggest tech companies are placing their biggest bets on the atom. Now, get this is a huge gamble. TerraPower's reactor just recently cleared a major environmental and safety review, but it's still aiming for a 2030 operational date. These projects are famous for delays and cost overruns. In other words, where XAI grabbed immediacy with natural gas and absorbed the backlash, Meta is opting for cleaner optics and firm power with longer timelines and execution risk. It's a bet on cutting-edge technology that has yet to prove it can be delivered on time and on budget. While giants like Meta are making massive long-term bets on AI infrastructure, the AI revolution is also happening on a much smaller scale right on our shelves. Just 2 months ago, the collectible giant Funko warned its investors there was substantial doubt over its ability to continue operating. The company behind the pop vinyl craze is in serious trouble. And we're not just talking about a small slump. In the third quarter of 2025 alone, Funko reported a 14% drop in net sales and a net loss of about $1 million. This isn't just a slow season. It's a sign of a deeper problem with overproduction and changing tastes, which is creating a massive opportunity. And now, 2 new startups are moving in, betting they can conquer the market. Funko is losing their weapon, artificial intelligence. The first challenger is Buddyo. It's not trying to replace your Funko Pops on Nintendo Amiibos. It's trying to bring them to life. The company is launching an AI pod, a smart base that uses NFC technology to recognize your existing figurines. You take a photo and its AI generates a backstory and a personality, letting you chat with Mario or Darth Vader right from your desk. The company's CEO, a former Google AI engineer, is even letting users upload sound samples for copyrighted characters, a risky move he hopes will keep the infamously litigious Nintendo at bay. This is a high-stakes gamble because this ask forgiveness, not permission strategy is walking into a legal minefield. We've seen this before. AI companies like Midjourney have been hit with massive lawsuits from giants like Disney, Warner Brothers, and Universal for allowing users to generate images of their copyrighted characters. By letting users create personalities for Mario or Darth Vader, Buddyo is practically daring these companies to sue them. But the battle for your shelf space doesn't stop there. A rival startup, HeyMates, is making a completely different bet. Its CEO declared he wants to build the next Funko Pops but make it AI. Instead of upgrading old toys, HeyMates is launching its own line of figurines with AI chips already inside, starting with characters like Albert Einstein and a sarcastic 90s sitcom friend. Now, this is where things get ethically complicated and, honestly, a little bit strange. Creating an AI version of a deceased person, whether it's a historical figure like Einstein or a beloved, recently deceased actor, opens up a huge can of worms. The thing is, the law is scrambling to catch up. Some places, like California and Tennessee, have posthumous personality rights laws that give estates control over a person's likeness for decades after they die. But there's no federal standard. So who gets to give consent for an AI to act like your grandfather or a famous celebrity? It's a huge unanswered question, They're aiming for total creative control, predicting the market is about to boom with rivals and imitators. So you have a dying giant and two challengers with completely different strategies. The situation presents a fascinating duality. This is a classic platform war, just like VHS versus Betamax, or Apple's closed ecosystem versus the open Android model. Buddyo is playing the Android game, hoping to build a huge network by working with everyone else's toys. HeyMates is taking the Apple approach, a closed-controlled system where they make the hardware and the software. Research shows that open platforms often win in the long run because of these network effects, but a closed system can guarantee quality. It's a fascinating showdown of strategy. With Funko sales slowing and its future in question, the stage is set. Its inaction may be the very opening these new companies need to take over the space. One way or another, chatty, AI-powered collectibles are coming. But this brings up a crucial point for all of us. In our own homes, these devices are essentially always-on microphones, powered by learning models, often in a child's bedroom. And we have to ask, how is our data, and especially our children's data, being protected? Regulations like the Children's Online Privacy Protection Act, or COPPA, exist, but we've seen toy companies in the past fail to secure data, leading to massive breaches of kids' voice recordings. So as these chatty friends arrive, the big question isn't just what can they do, but what are they listening to? That's a question of future risk. And speaking of managing risk and sudden strategic shifts, the auto industry just saw a massive one. The company that has dominated the American plug-in hybrid market is suddenly killing its most popular models. Just a short time ago, Stellantis, the parent company of Jeep and Chrysler, was touting its US sales leadership, representing a staggering 41% of the entire plug-in hybrid market. The company's then CEO of Jeep even projected selling up to 170,000 of these vehicles in a single year. We're seeing Stellantis abandon its leadership position, while at the same time, its biggest rival, Toyota, is taking a completely different path. Toyota is actually expanding its hybrid and PHEV lineup, aiming for them to make up 20% of its US sales by 2030. This highlights a huge strategic disagreement among the world's biggest car makers about the future. A while back, we walked through how Detroit's other giants were already pulling back, Ford bracing for a $19.5 billion charge, and GM taking a $7.1 billion hit while restructuring in China. Stellantis is now the latest to blink, but with a twist. It's not just trimming BEVs, it's axing the very PHEVs that were propping up its US numbers. But now, in a stunning about-face, Stellantis is scrapping its entire plug-in hybrid program in North America. The Jeep Wrangler 4xe, the Jeep Grand Cherokee 4xe, and the Chrysler Pacifica PHEV are all being discontinued, beginning with the 2026 model year. So what's the real story behind this U-turn? The official statement cites waning customer demand, but the story goes much deeper. Now, that claim of waning demand is interesting because the data tells a slightly different story. In 2023, sales of the Jeep Wrangler 4xe actually shot up 56% to over 67,000 vehicles. The Grand Cherokee 4xe was up an incredible 636%. This suggests the problem might not be the technology itself, but the price. This decision was the result of a perfect storm, slowing EV sales across the industry, the end of up to $7,500 in federal incentives, and weakened fuel economy regulations that made these vehicles less critical to the company's bottom line. The loss of that $7,500 tax credit is a huge deal. Research shows that PHEV buyers are extremely sensitive to price. One study found that for every 1% increase in price, demand for a PHEV drops by 2.3%. So when that credit disappeared, these already expensive vehicles suddenly became much less attractive. And remember, we've also talked about the cost side of the tech stack. GM's Ultium has been pricier to build than rivals, while BYD's Blade came in roughly $10 per kilowatt hour cheaper. Those kinds of gaps make it even harder for legacy PHEVs to pencil out without incentives. And then there's the regulatory whiplash. This is exactly the policy whiplash we broke down a while back, where US rules swing with each administration while China and Europe stay steady. For years, automakers like Stellantis have faced huge fines for not meeting strict corporate average fuel economy or CAFE standards. In fact, Stellantis just paid over $190 million in penalties in 2025 alone for missing these targets. Selling PHEVs helped offset the emissions from their popular gas-guzzling trucks, but with those rules now being relaxed, the financial pressure to sell those hybrids has eased significantly. But that's not the whole picture. The move also follows a string of quality issues, including a major recall of the Jeep SUVs due to fire risk. This wasn't a small issue. We're talking about a recall of over 320,000 Jeep Wrangler and Grand Cherokee 4xe models. The cause was traced back to the high-voltage battery packs, where damaged internal cell separators could cause a short circuit and, well, a fire. The National Highway Traffic Safety Administration documented 19 fires and at least one injury. The problem got so serious that Stellantis had to officially advise owners to park their vehicles outdoors, away from any buildings, and to stop charging them altogether until a fix could be found. When you're facing that kind of liability and repair cost, suddenly discontinuing the whole program might start to look like a sound financial decision. For years, Stellantis used these expensive-to-build hybrids as a strategic tool to offset its gas-guzzling trucks and meet tough federal standards. With those pressures easing and demand shifting, that entire strategy has collapsed. This isn't an exit from electrification, but a massive strategic failure and a pivot. Stellantis is now ditching the transitional technology it once championed to focus on other electrified solutions, including all-electric SUVs like the Wagoneer S and Recon. And with that pivot, they are betting on something called a range extended electric vehicle, or REEV, like the new Ram 1500 Ramcharger. A REEV is different from the old Jeep hybrids. In the Jeeps, both the gas engine and the electric motor could turn the wheels. In a range extender, only the electric motors drive the vehicle. The gas engine is just there as a generator to recharge the battery when it gets low. The idea is to give you the smooth, powerful feel of an EV, but with a gas engine to eliminate range anxiety, especially for things like towing. It's a simpler system that Stellantis hopes will be cheaper to build and more reliable, offering a better bridge to a fully electric future. One more angle we can't ignore. We previously analysed how big company cancellations ripple through the North American EV supply chain, battery makers and component suppliers suddenly staring at reduced orders, even bankruptcy risk. Stellantis pulling these volumes could be another shock to an ecosystem that still hasn't found its footing. The king of plug-in hybrids has just abdicated the throne. That's a public admission of a failed strategy, but you know, there's a much quieter form of de-risking happening behind the scenes in Silicon Valley. The story begins with a warning that caught everyone's attention. A top strategist at Morgan Stanley is cautioning that a stock that's been amazing for years can suddenly become a dumpster fire. And that single fear is driving a massive behind-the-scenes move by the tech elite. While the world is piling into soaring tech and AI stocks, many of the founders and executives who got rich from them are facing a critical problem. They have too much of their wealth tied up in one place. One financial advisor calls it the biggest risk and biggest opportunity for his clients, a stark contrast to the rule of thumb that no single stock should be more than 10% of your portfolio. Actually, this isn't just about simple financial planning. There are powerful psychological biases at play, sometimes called golden handcuffs. One is the endowment effect, which makes people overvalue something simply because they own it. Another is overconfidence. If you helped build a successful company, it's natural to believe it will always outperform the market. Wealth managers say they have to actively coach these executives to overcome a deep-seated fear of regret, the fear they'll sell just before the stock soars even higher. So they're using a sophisticated tool from the 70s to quietly de-risk. It's called an exchange fund. A group of wealthy investors all contribute their high-value shares from their own companies into one giant. In exchange, they get a piece of a new diversified fund. And here's the key. By doing this, they can avoid paying a fortune in capital gains taxes. Here's where it gets interesting. To qualify for this tax break under IRS rules, these exchange funds must hold at least 20% of their assets in something other than stocks, and that something is almost always real estate. It means that as tech insiders pour their shares into these funds, a significant portion of that money is being passively funneled into commercial and luxury real estate. This creates a hidden link where the AI stock boom is directly fueling the real estate market, all happening quietly behind the scenes. There's a major catch. They have to lock up their money for 7 years. If they pull out early, they lose the tax benefit. So why are they willing to lock away their fortunes for that long? The answer, according to research from Morgan Stanley's wealth division, is chilling. Stocks that have massively outperformed in the past actually tend to underperform in the future. The quote from an investment strategist is a stark reminder. People remember the blessing the stock has been to them and their family, and they're extrapolating forward that the blessing will continue. But the data suggests it often won't. Even with this strategy, there are still risks. That 7-year lockup creates a major liquidity problem. But more importantly, there's a concern about systemic risk. Because these funds are pooling stocks that are often highly correlated, think about it, a lot of big tech stocks tend to move together. A major downturn in the tech sector could cause all the assets in the fund to fall at once, undermining the whole point of diversification. It reveals a sharp divide. While the public market is betting on these companies to keep flying high, the insiders who know them best are systematically taking their chips off the table.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.